The money that is in your bank account may not actually all be there. At first, you may compare this to a conspiracy theory, but the situation is different from that. In fact, this is among the most fundamental truths of the financial system. Just think about it. If everyone went to their bank tomorrow at the exact same time and said, "I want all of my money in cash," the system would most likely become frozen within hours, because not all of the money that appears in bank accounts physically exists inside the banks. And no, all of this does not mean that the system is operating incorrectly. On the contrary, the system was actually designed this way from the very beginning. For many years, a large part of the world has been operating with this system. It has been used for such a long time that nobody even finds it strange anymore. The name of this system is fractional reserve banking. At the very foundation of today's debt system, inflation, and the monetary system lies this operating mechanism. Once you learn how it works, you realize this. A large part of what we call money today is nothing more than promises that are said to be fulfilled in the future. In order to understand this, we need to go back a little into the past, to the time when phone applications, mobile banking, and credit cards did not exist, to medieval Europe. Back then, money truly was gold and silver. Wealthy people would hand over their valuables and gold to trusted goldsmiths instead of carrying them themselves, because carrying them was both difficult and highly risky. You would hand over your valuables and then receive a receipt in return. The meaning of that receipt was this: come whenever you want. Your gold will always be here waiting for you. At the beginning, the system was quite simple. The gold and valuables were inside the vault, while the receipt merely represented them. But over time, instead of using gold while making purchases, people began using the receipt, because everyone believed that there really was gold behind that piece of paper. This is exactly where everything was about to change. The goldsmiths realized something important. Almost none of the customers came to collect their gold at the same time. A large portion of the gold remained untouched for months, so they began to think, since not everyone comes to collect their gold at the same time, what would happen if we prepared more receipts than the ones we have? And that is exactly what they started doing. Whenever they had 1,000 pieces of gold in their vaults, they wrote 2,000 receipts and began using the extra receipts they had created to lend them out with interest. In other words, they began earning income from gold that did not exist. The interesting part was that the system worked. Because people did not want to collect their gold at the same time, nobody noticed the shortage. They had, in fact, created new money that did not physically exist. From then on, people no longer trusted the gold itself, but the receipt that represented it. It was exactly from this point onward that money stopped being a physical object and became a system built on trust. The foundation of modern banking was laid right here. Banks took this idea, began applying it on a much larger scale, and built the foundations of the financial system that we know today. Later, governments also realized the power of this system. Especially as the cost of wars increased, it became needed even more. In 1694, the Bank of England was established. Its real purpose was not to protect the interests of the public, but to make it easier for the government to obtain loans. The bank created an amount of money greater than its actual reserves and lent it to the government. The government, in turn, was able to repay those debts with the taxes it would collect in the future. In fact, the mechanism that operates today is almost the same. Money that does not yet exist is used to borrow money in the present, and this model soon began to be adopted by other countries as well. The model introduced in England reached America in a very short time. The first banks began issuing banknotes backed by the gold that had been deposited. Whenever you returned your banknote to the bank, you could also get your gold back. Because of this, people believed that the piece of paper in their pocket truly represented the gold kept inside the vault. But banks also realized the same truth that the goldsmiths had discovered years earlier. Most people did not come to withdraw their gold at the same time. Because of this, banks also began issuing more banknotes than the amount of gold they had in their vaults. At first, everything seemed to be working perfectly, until people began to panic. Even the smallest rumor in the economy would immediately cause people to rush to the banks, all trying to withdraw their money at the same time. And this was called a bank run. That was exactly when the truth began to reveal itself. There was not enough money inside the vault for everyone. People could not withdraw all of the money shown in their accounts. Because of this, many banks were doomed to fail. One would think that after events like these, the system would have changed. But the exact opposite happened. Instead of eliminating the system, governments made it even stronger. Central banks were established, new regulations were introduced. But the foundation of the system remained unchanged. The message was simple. As long as people believe that their money is safe, the system will continue to operate. Because the most fundamental element of this system is not gold, it is trust. Now let's bring this into the present day. Because the same principle is still active in bank accounts today, let's say you deposit $100 into your bank account. You probably think that the money is sitting there in your account. But in reality, the bank does not keep all $100 inside its vault. In the past, banks in many countries were required to keep a certain portion as reserves, for example, 10%. When you deposited $100, the bank kept $10 aside and lent out the remaining amount as loans. That money was then deposited into another bank and turned into another loan once again. This process continued over and over again. At the beginning, only $100 entered the system, but because of the lending mechanism, the amount of money circulating became hundreds of dollars. This is called the money multiplier. But the important part is this. The original money was still only the first $100. All of the other money that had come into existence consisted of loans, that is, debt. In other words, a significant portion of the money circulating today first comes into existence as debt. Someone takes out a loan, the bank creates new money. That money is spent, transferred into other accounts, and begins circulating throughout the economy. In other words, the money supply increases even without printing new banknotes. The main reason for this is that banks are able to create credit. But today, the system works a little differently. Since 2020, the required reserve ratio in the United States has been reduced to 0. This leads many people to ask the following question: will banks be able to issue unlimited loans from now on? No, because what limits banks today is no longer reserves. It is capital adequacy and liquidity regulations. In other words, a bank has to prove that it is strong enough to cover the risk created by the loans it gives. This is exactly where the Basel rules come into play, especially after the 2008 financial crisis. These rules became much more important. Their logic is quite simple. The more risk a bank wants to take, the stronger its capital and the more liquid assets it must be able to demonstrate. So even though the mechanism appears to have changed, the basic principle is still the same. Banks still create credit and create new money. Only the rules they have to follow while doing so have changed. Perhaps the most surprising part begins exactly here, because many people think that banks first collect deposits and then lend that money out. But the modern banking system no longer works that way. Today, in many cases, the process works in the opposite direction. First, the loan is created, then the money comes into existence. Imagine buying a house. You go to a bank and a mortgage loan is approved for you. At that exact moment, the bank does not take someone else's money out of the vault and hand it to you, because there is actually no pile of money there the way most people imagine. The bank simply writes a new balance into your account. Money that did not exist there just a few seconds earlier now appears in your account. In other words, new money is created together with your debt. Only afterward does the bank check whether the loan it has issued complies with the regulations. Does it have enough capital? Can it meet the liquidity requirements? Does it remain within the risk limits? Those are the things it checks, but by then the money has already been created. That is why a very large portion of the money circulating throughout today's economy does not consist of banknotes printed by central banks, but of bank money created when commercial banks issue loans. In other words, a significant portion of the money you see in your account has actually been created from someone else's debt. Stop for a moment and think carefully about that. The money in your account could be a loan taken out by someone else. Even the money deposited into your account as your salary may have been created because a company borrowed money. A large portion of the money circulating today first came into existence as debt. That is exactly why the system constantly tries to create new credit. Because without new lending, the creation of new money slows down significantly. The economy feels that very quickly. For this reason, financial crises are not merely money crises, they are also crises of trust. When people cannot repay their debts, when companies are pushed into bankruptcy, when banks cannot recover the loans they have issued, everyone begins to distrust one another. And the moment trust weakens, the system itself begins to shake. This has three major consequences. The first is inflation. As the amount of money in the economy increases, the purchasing power of that money decreases over time. Of course, this is not the only cause of inflation. Production costs, energy prices, and supply problems also play a role. But the continuous increase in the amount of money created through lending is also an important part of the process. So it is not only products that become more expensive, the money itself also begins to lose value. The second consequence is the debt cycle. Within this system, money is created only through lending. But what has to be repaid is both the loan and the interest. Because of this, the economy must constantly grow and continuously create new loans. Otherwise, the money in circulation is not enough to repay the total amount of outstanding debt. Companies, governments, individuals continuously create new debt. Debt never truly disappears, it simply changes hands. The third consequence is that wealth gradually becomes concentrated in certain parts of society. The reason is that the first recipients of newly created money are generally banks, large corporations, governments, and institutions that are closely connected to the financial markets. When new money first enters the system, prices have not yet fully increased, but as time passes, that money spreads throughout the economy and pushes prices upward. The people who are affected last are usually those who work for wages. This is because wages generally do not increase as quickly as prices do. As a result, the same salary can buy fewer things. On the other hand, wealthier people may, in many periods, be less affected by inflation. Of course, the banking system is not the only reason for this. Taxes, technology, education, investment opportunities, all of these also play a role. But the way the monetary system works is also an important part of the overall picture.
So, can this system continue forever? No one can answer that with certainty. But history clearly shows us one thing. Whenever people lose confidence in the system, the entire structure begins to shake. One of the clearest examples of this was the Great Depression of 1929. During those years, banks had issued enormous amounts of credit, while the stock market kept rising. Everyone believed it would continue forever. Then confidence disappeared, as people went to the banks to withdraw their money. But there was simply not enough money in the vaults for everyone. Hundreds, even thousands of banks collapsed. Millions of people lost their savings. Years passed. Technology advanced. Banks became larger. But the foundation of the system did not change. Then came 2008. This time mortgage loans were at the center of the crisis. For years, banks had been issuing more and more loans. Those loans were bundled together and sold to investors all over the world. Everyone believed the system was working perfectly, until some people could no longer repay their loans. As the debt stopped being repaid, the entire structure began to collapse. Many major financial institutions came to the brink of bankruptcy. The global economy almost came to a standstill. So what happened afterward? Did the system completely change? No. Central banks and governments created massive rescue packages to keep the economy alive. Banks were provided with liquidity. Interest rates were lowered. New money was created. After that, the Basel rules became even stricter. Today, the banking systems of many developed countries operate largely under these rules. In some developing countries, reserve requirements are still mandatory. But the common principle has not changed. Today, the limit on money creation is determined not by the gold inside the vault, but by banks' capital positions and financial regulations. After hearing all of this, one question naturally comes to mind. What would happen if everyone paid off all of their debts starting tomorrow? At first glance, that sounds wonderful. But because a large portion of the money circulating in today's system was created through lending, If all debts were repaid, the money supply would also shrink dramatically. The creation of new loans would slow down. The speed of money circulating throughout the economy would decrease. Production, consumption, and investment could all be affected. The current system is like a bicycle that has to keep pedaling continuously. The moment it stops moving, it becomes much harder to keep its balance. So, what is the conclusion we should draw from all of this? First of all, having money is not the same as being wealthy. Having money in a bank account alone does not mean you are rich. Real wealth consists of knowledge, skills, productive capacity, and real assets. Debt itself is not necessarily bad. When used correctly, it can help people buy homes, allow businesses to grow, and make investments possible. But using it without understanding how it works can involve serious risks. Inflation is not just about the price tags you see in supermarkets. It is directly connected to the way the monetary system functions. That is why understanding finance is important, not only for investors, but for everyone. The purpose of this video is not to create fear, but to explain the mechanism operating behind the scenes in a clearer way. Because being aware is always one of the very first steps. From the goldsmiths of medieval Europe to the global financial crisis of 2008, this story tells us only one thing. The financial system is built largely on trust, and trust is something that takes many years to build, but sometimes only a few days to lose. So the next time you look at the balance in your bank account, remember this. The number you see there is not just money. It is also an example of how today's financial system actually works. The better you understand the system, the more informed your financial decisions can become. Because even though history does not repeat itself exactly, it often follows remarkably similar patterns. Understanding the past is one of the strongest ways to better understand the future. If this video gave you a different perspective, don't forget to subscribe to the channel and leave a like. Because history still contains countless stories that can help us better understand the present, and together we will continue discovering them.